Welcome to the G360 Wealth Podcast. Today, we are excited to be with Jake Marriott. Jake is an options portfolio manager at Aptus Capital Advisors and a local to Generation Capital Advisors, home away from home, Naples, Florida, which I desperately wish I was in right now, watching the snowfall here in Boston. Jake, welcome to the show.
Sam, thanks for having me.
I must admit to our listeners, this is the second time I've had you because when I recorded the first episode, Rex was out of the office and apparently I can't use technology. So I apologize for the double take, but this episode will be double the fun.
Yep, I'm looking forward to it.
So for our listeners out there, I want to underpin this episode with that there might be some complexity that we discuss in this episode, but what our goal is to distill it down to something that's pragmatic and real that can help you with your portfolio. This is probably going to relate to those who have a concentrated position, but there is a multiple and magnitude of way to use options in a portfolio. And what our goal is to educate our listeners on when and where is it appropriate. In some cases, options are totally inappropriate, especially for those who, it doesn't align with their investment policy or their understanding of the product. But I want to start at the most basic level, Jake. What are the types of options that regular people use? I'm not talking about like, a quant fund or a hedge fund. What are you seeing that, somebody would want to entertain options? It sounds very scary. Like, what is the point of this?
Yeah, that's a great place to start. So just at a very high level, you have two types of options. You have calls and you have puts. A call or all options are an agreement with the counterparty to either buy or sell a specified amount of shares at a specific price at some time in the future. So there's a lot of things going on there, but we'll walk through it. So to start off, if you were to buy a call, that means that I want to own this stock at a price in the future. So I want the ability to buy the stock at the strike price in the future. So I'm going to pay, let's say, $1 to own this call. If the stock goes above that strike, the price in which I have the right to buy it, then I'm going to exercise, or the contract will automatically exercise, and then I'll get to purchase those shares at that strike in the future. The opposite of that, which is much more relevant to our conversation today and common for concentrated stock positions, would be a covered call. And in a covered call, you are owning the stock and you're selling a call, which it is an agreement such that you have the obligation to sell this stock at this price at some point in the future, right? So in this case, if our stock's at $100, we sell a call at $110. If the stock goes above $110, then we're going to sell that to the counterparty for $110. But in the meantime, if it stays flat or doesn't go up above $110, we get to collect that premium. Someone's willing to pay for that option.
Okay, so buying a call, you're not actually buying the stock, right? You're buying the right to buy that stock at a certain price. So would it be fair to say, like, buying a call is like dipping your toes in the water? You want to have the ability to buy the stock, but you don't want to own the stock outright.
That is spot on. Yes. So
Yes.
a riskier stock, I know you mentioned let's keep it to our concentrated stock positions or our retail clients, but there are a lot of retail clients that are out there buying calls in their personal accounts, which I'm sure you're aware of, Sam, and probably are saying don't do that. That can be very risky, right? The benefit of buying a call is the most you can lose is what you paid for the call. Right. And so where if you buy the stock, obviously, if the stock goes to zero, you're going to lose everything that you invested. So it is a speculative bet, but it is there's a limited loss to it.
I see. So for those folks who are interested in kind of dipping their toes in the water, the most they can lose is what they pay for the contract. So these aren't the type of options that have unlimited loss potential, right? You put the money in. If the stock goes to where you want it, you execute it. And then how does that work from there? Do you sell your options contract? Do you assign the contract? What happens when you get to that point in the future?
Yeah, that's a great question. So you have the choice to either sell your calls. So you bought this call, it's in the money, the stock went up, so you were right. You have the ability to just sell the call for more than what you paid for it. So you paid $1, now it's worth $5. You made a great bet. Let's move on and do it again, right? Or you have the right to exercise the option, which would be buying the shares at your strike price. So just to run back through real quick, stock's at $100. You buy the 110 strike, stock goes to $120. You have the ability to either sell your call and keep your gains, or you can buy all those 100 shares at $110.
Okay, let's double click on the other side of that, right? Because most of our clients and most high net worth investors are probably more interested in selling the call. Many folks, whether they're executives or multi-generational families, have come across a stock, maybe Nvidia, Apple, Microsoft, that they paid a bag of marbles for 15 years ago, and now they've got a huge amount of an appreciation. And they don't want to sell that stock because they're going to trigger a capital gain. We've had many episodes on tax mitigation strategies, which we'll probably get into a little bit in this episode, but they also want to monetize that stock. So maybe the stock doesn't pay a dividend, uh, or maybe it pays a low dividend, and they want to do something with that or protect the downside a little bit. Let's dial in. Let's talk about Nvidia, which pays a low dividend. Obviously, the returns have been spectacular over the last even 5, but if you've had it for 10 or 15 years, now you have a huge amount of appreciation, but you also may be looking at a substantial tax bill to monetize that position.
Yeah, so this gets into our bread and butter, right? This is the concentrated stock position with the low basis. So there's 3 directions we can go within our options overlay space for these types of situations. The first one would be the income bucket. That's a client who is kind of exactly what you explained initially, right? I want to make useful of these assets, but I don't want to sell them because I'm not willing to take or to pay the tax consequences at this point in time. So to do that, we can sell covered calls with the intent of retaining the shares. So these are going to be what we call conservative covered calls. More specifically, we're looking at deltas between 5 and 15. And when I say the term delta, you can think of it as the percentage likelihood of that option finishing in the money. So the covered call income bucket, we're going to sell conservative covered calls, but we're going to generate some income, some meaningful income while we hold on to this position. Does that
Okay,
make all
so
good there?
yeah,
Mm-hmm.
to me it is. So let's distill this down. So let's just say we've got Nvidia out there. I'm the buyer of the call, and you're the seller. I'm going to give you $50,000 for specified amount, right? I'm buying that. I'm hoping the stock goes up past a certain point. You own Nvidia and you are selling me those rights. So I'm effectively paying you. So as the seller, you're hoping for the stock stays flat to negative, somewhat up, and that all depends on what those fancy Greek terms you're talking about.
Yeah, so the best scenario if you're selling the calls is that the stock goes up to your strike price, because then you're going to get all of the appreciation of the stock, and then we keep that $50,000 that you gave me for selling the option. So that's the best scenario. Now, where we get into if the stock is flat, then obviously nothing happens to the notional value of the position, but we still collect our $50,000. Where it gets interesting is if the stock does go above our strike price, right? Ultimately, we said we do not want to sell all of our shares, especially not at once, right? So if we didn't do anything and the stock price closed above our call strike, we would be forced, or we would have the obligation to sell all of our shares at the strike price or I would have the obligation to sell them to you at that strike price. But what we can do to avoid that and avoid the tax consequences of that is we're going to buy back that option prior to expiration. So I sold you the option, but I'm saying I actually want to buy that right back from you, right? And the cost of that at expiration is going to be how much the option is in the money. So if the option is $1 in the money, then at expiration, I can buy back that right from you for $1 per share. And that avoids the tax consequences.
I see, because if I am the buyer of the call and I want my NVIDIA, well, you have to give up that NVIDIA, and you may have a $5 million gain, a $3 million gain. When you give up that NVIDIA, you're effectively transacting that, right? So now the risk to the investor is that if you get called away, you're giving up that NVIDIA, you got paid $50,000. You're going to get your money up until that strike price. So you're going to get your $5 million out, but you're also going to have a $5 million gain, which you may owe 20 plus 30, with state taxes. Hopefully most people are in Florida or a tax-free state like Nevada
Yeah.
and they don't have to pay the state taxes, but now that could trigger a gain. So we want to avoid that, right? Because that's the consequence that no one likes. You pay 50 grand, so you get paid 50 grand. Of course you get your principal out, but then you owe $1 million in taxes.
Yeah, exactly. We're trying to avoid that. And one thing I think that's important to mention is just because the option goes in the money at any point in time does not mean that it will automatically execute. And I'll quickly go through this just because I think it's important when people first start these strategies, they reach out and they're like, my option's in the money. Like, what are we going to do? It's like, if there's time remaining until that option expires, there is very often very little risk that you're going to be exercised early. And I think using the example of you being the buyer and me being the seller is really clear in how to explain this. So you bought an option. I sold you the option for $1, right? So you paid $1 for this option, and then after a week of the 1 month option, now the it's already in the money. So the stock's gone up and the option's in the money, right? So you could exercise the option early, and you would get only the amount that the option is in the money. So let's say you bought the 100 strike, the stock is now at 105. You could get $5 if you exercise the option today, but because there's 3 weeks left until the option expires, you can sell that option for way more than the $5 that you would get if you exercised it. So we are always monitoring the likelihood of an option to be exercised early, and if anything changes, which some of the criteria are normally the stock pays a dividend or the option is really deep in the money. But other than those two situations, it's very unlikely for you to be at risk of an early exercise.
Got it. Very timely with the Olympics going on, because there's the American, European style options. So what style of options are you writing or buying?
Yeah, so we're dealing mostly with American style options, which means that they can be exercised at any point throughout the life of the option. And this is when you see like listed options markets, what you're trading in your E-Trade or whatever. So, your discrete PA account on the side. That's going to be American options. And then you have what's called European options, which only can be exercised or are automatically exercised at expiration. So that's like things like index options are European settlement and flex options are European settlement.
I see. Okay, so bringing this back down to somebody who's a senior executive or retired and have positions that they've acquired along the way. What happens at expiration is, if you're in the money, right, you close it out, and as far as the seller, and then you try it again. Is that typically how it works? Like, you keep on collecting your income. That income gets paid to your account in a dollar amount. So in your Fidelity or Schwab account, you're getting that $50,000 cash money.
That is correct.
Now, what happens if it goes the other way, right? So what are your, pardon the pun, options if, let's just say, NVIDIA rips? Now you're way out. So we're going to have to, and we don't want to give up that option. We're going to have to buy that back. We're going to have to put cash money out.
Yeah, that is correct. So our standard would be when we buy back that option, if for every dollar it costs more than what we initially collected. So in the example that we have been running with here is, we collected $50,000. Let's say it cost $100,000 to buy back that option. So now we have a $50,000 loss in the account. that can be used to help offset the gains from the sale of that concentrated position or the gains from other stocks within the portfolio. So generally, our standard would be, NVIDIA. Let's say NVIDIA rips up way above our call strike. We're going to have a loss in the options, and we're going to sell or trim our NVIDIA position. And one of the benefits of this is we're only selling NVIDIA when it's up a lot over a short period of time. So I know that like maybe the intent isn't to sell shares, but you have to realize that even after selling these shares, your notional value of NVIDIA in your account is up. So you're going to be up by the percentage out of the money that the call is that you sell. So it's not like you're not net, you're not losing money. Your account will still be higher than when it started in this situation.
You're just capped, right? So it's important to understand if your cap, is 5% up, you have $1 million and NVIDIA goes up 25%, you're going to be collecting that 5% up to the cap. And then, me as the buyer, I get that 20% delta because I was betting on it going up.
Correct.
And maybe that leads to my next question is this an income strategy or a risk management strategy or both, or like kind of how does it all work?
Yeah, it could be either one. It can be considered either one. I think it really depends on the structure and the goals of the client, right? Like if we can solve it for an income target, like you have an income need for the year and for living or whatever it might be, and yeah, we can just target that income and allow for the most upside participation as possible with that, let's say 5% income target or something like that. But in the meantime, it is a risk mitigation strategy because the income you collect is somewhat buffering your downside, right? So even just to cover call, if the stock's down, let's say you collected $50,000 in premium and the stock's down a few dollars, then that equals $50,000 of notional value of the stock. You're technically hedged. Now it's a very small hedge. It's not as protective as the puts that we'll, I'm sure, talk about here shortly. But it can be structured such that it is just a strict income target mandate, or it could be a risk mitigation mandate, which I think the collar, which we'll talk about in a little bit, is a better representation of the hedging, obviously.
Yeah, let's maybe pivot that way. And I think, maybe we'll wrap up the conversation at the end. We can talk about expectations, which I think are really important with options, with all the democratization of all these investment managers coming to market. But let's give the example. I'm an executive. I've, hit my retirement. One thing that's important to note, typically if you're an executive at a company, you cannot hedge your position. That's, betting that it's going to go down in any sort of way. Please be sure to check with your general counsel or compliance before you engage in any of these strategies. But let's talk about the other side. Like, okay, I got 50,000 on my NVIDIA position, but it went down. It's 2022. Now it's down 30%. Like, okay, I'm still down 250 grand. I'm, screaming into my pillow at night. How do I prevent that?
Yeah, it's a great point, and obviously this is like the perfect scenario for this collar strategy. So in a collar strategy, we're combining the calls and the puts. So we're selling a call just almost exactly the same way as what we talked about earlier, but instead of just putting that $50,000 in our pocket, we're going to use that $50,000 to buy protection. So that is the put. We're going to buy the put, and the put acts as downside insurance for your stock, right? So if you own a put, you are locking in a floor for that period of time, through the life of the put. So in the case we've been talking about, stocks at $100, you buy protection or you buy your put at $90. If the stock goes below that $90, you are not susceptible to any additional losses. So if it goes to 80, you have the right to sell that stock at $90, even if the stock's at $80.
Okay, the first thing that I'm thinking of is a flashback to sitting in a Prometric, like 13 years ago, taking my Series 7 with that like grid chart. You remember that, like buy, put, sell, call. Like, why is this 60% of the test? So buying the put, we're going to outlay cash. We are paying for protection. So if I'm betting against the stock, I'm going to pay Jake to bet against it because I'm a buyer. And if that stock goes down, then what happens? Do I get to buy the stock at a certain price that it's actually not trading at?
So if you are long the put, you have the right to sell it at that strike price. So in the example that I gave, if you're long the 90 strike put and the stock goes to $80, you can sell it for 90, even though it's only worth 80. So you're going to collect those $10 per share, and that's the value of your put protection.
Got it. So if I'm a put buyer, stock goes up, I outlay my cash, I'm just out of the cash, right? There's no unlimited loss potential. That is a capital loss, right? I've paid for something, I've lost the money, it's gone. But I also am able to sleep at night. So your net return would be the return of the stock minus what you've paid.
Exactly. Yeah, so just to bring that all together in the collar example, if we are using the $50,000 in income we generated from selling the call to pay for protection that costs $50,000, if the stock stays within those two, the call and the put strike, then it's a wash, right? We have a loss from the calls, we have the gain, or I'm sorry, we have the gains from the calls, and we have the loss in the puts, and then we just move on with our life and we do it again. So that's where in an uptrending market, which we talked about earlier for the cover calls, another benefit of when you're collaring a position and the market is going up is that floor is going to be moving up with it. So essentially we're creating a band around our concentrated stock position, and that band is reducing the volatility of that position within our account. Because if it goes down in value, if the stock goes down in value, our puts are going to be up in value. And if the stock goes up in value, then unfortunately our calls are going to be more expensive to buy back. So, but in all, you can expect the volatility of that position to be significantly reduced.
Okay, so what the most popular strategy amongst our clients are is many of our clients have already amassed significant wealth. They want to protect it. So a strategy that is very made famous, I think, by Mark Cuban, did this in the early 2000s, is what's called that, right? That cashless collar. So you sell the call, you get paid, you take that money, and you buy the put. Seems like there's a lot of complexity and a lot of numbers along the way. How do you manage that? I'm sure you have a
Yeah,
Bloomberg terminal and 17 screens and 5 cups of coffee.
those all go into it for sure. But so it really starts with the goals and knowing the details of the client situation, right? Um, Now that would start with being like, are you open to selling shares? Would you prefer to never sell shares? How nervous are you about this stock position? How much of your net worth is locked up in this one position? What is your other planning like? Are you going to have to is your lifestyle going to change if this position goes down by 50%? And all of those questions get asked, and then we come up with an investment policy statement that is saying it's giving us standing instructions for the goals of the client. It's telling us how we are supposed to trade this account through time. So an example of a costless collar investment policy statement would consist of things like, I want to protect my position at 90% of the current stock price while maximizing my upside for zero initial costs. Okay, that's an investment policy statement, and that's something we can run with. And then it's really just like you mentioned, we use Bloomberg and other pricing tools to make sure that execution is as good as possible, and that we are ultimately we are accomplishing the goals of the client through the investment policy statement.
Got it. And then so to bring this into reality of like how this can actually work, to ultimately what many of our clients are trying to do is monetize their position into a diversified portfolio. Maybe, God forbid, buy some bonds, right? Some municipal bonds, get some income. Reduce risk. Most of our clients have made their wealth. They want to protect it, and they want to be able to sleep at night. They want to bring that standard deviation down, but they also don't want to pay an enormous tax bill. So we're seeing a lot of I'm getting a penalty here. We'll have to
Yep,
edit this because I'm getting a phone call. So
all good.
I second taboo because Rex is out of town. I didn't put my phone on mute. So uh, where we think about like marrying two strategies together of how to monetize these, I think a great strategy, and I'm sure you're seeing a lot of this, is getting that caller in, like saying, "Hey, my stock is at 700. I've never seen it here before. I want to put a floor in of 650 and maybe a cap of 720, whatever magic you guys can work." And the market's very efficient. The reason why I want to protect it is outside of that account, I want to run a direct indexing strategy or a long short direct indexing strategy. So we have an episode on this that Rex did on direct indexing, but just as a recap, that is a strategy that will allow you to participate in market returns while realizing capital losses. So these two strategies can work really well together in harmony because you can protect your position or you can have a predictable outcome. You can generate capital losses and participate in the market and then sell that strategy over the course of, in most cases, it takes a year or two or three. You can sell that strategy without realizing an income tax bill and then diversify into a different portfolio. And that's what we're seeing is the best type of planning for folks who want to risk mitigate. Of course, you have to understand there's no free lunch, Jake, right? Like you're not going to get all of the upside. Like if you're getting that 650 floor and the stock goes to 1,000, you can't come back and say, well, I want my 1,000. That's, despite, I always say, despite whatever investment manager wants to tell you that you can have your cake and eat it too, that rarely exists, right? You need to do thoughtful planning. And, from my side on the geeky, planning side is to your point, which was I think the most important is articulate what your goals are. Like what is the goal and the mandate of executing a strategy like this? Understand how it works and then stick to it, right? We see so many times, and that's why we're releasing our concentrated stock playbook and sticking and confirming to a plan because the stock keeps ripping and then, you give up on your strategy and then all of a sudden it falls through the floor and you're like, oh, I wish I bought my puts.
Spot on. Yeah. And just to add a little bit on the tax side, I don't think anyone does it better than you in this case, Sam. And I'm not just hyping you up. Like we preach that personally at Aptus, we do not have a direct indexing strategy, but I agree with you 100% that combining a well-structured collar to protect the concentrated position and then having I like to call like a sidecar of loss generating going on the side, and then you and I get to communicate, and you can say, hey, we've generated $500,000 in losses this year already. We'd like to start exiting or trimming out of this position. And then we unwind a certain amount of the options and we sell the shares, and it's all tax neutral. And so just to hype you up a little bit there, I do think you do a great job of that, and it's something that I would strongly encourage to do.
I appreciate that. I think it's all about, what our mandate is, like education and partnership, like figuring out what client goals are. And I think for many of our clients, right, it's that risk management approach. We ask the same thing like, how does your life change if your wealth doubles? For most of our clients, they were pretty savvy, pretty frugal, like to get to where they are. Their lifestyles don't really change. How does your life change if your wealth gets cut in half? Typically, the answer to that is significantly. Now, I want to add a point, maybe let you comment that before we start talking about what you guys do and how it makes it different. But these are strategies you can do not just on a single stock, right? You can write these on a portfolio. You can create, all sorts of magic with like hedging a portfolio. Maybe you have an SMA, a separately managed account that you got at some big bank where they talked you into buying like the best in breed tech manager that always sucks. And now you're like stuck in it. You've underperformed and now you're stuck in it because you have gains. And now you want to like kind of re-manage your portfolio and to get into something more balanced than the S&P, which beats everything. So you want to have like a diversified, globally managed portfolio, but we've got tax consequences and you don't want to take the double whammy of being in your super expensive SMA. Like now we're trying to get out of it. Your portfolio is out of whack and you have to pay capital gains, right? We can use options to kind of tweak that a little bit, right?
Yeah, exactly. So we can do in the example that you gave, and we actually have someone of pretty good size client recently that just started, and they had picked some good winners, Sam. Like they picked a lot of good winners, and thankfully we've been in an environment where that has been pretty common, but now we made it. And when I say these winners, we're talking about like 30, 40 stocks, right? So it's not like we can just slap a collar on it and move on with our lives. But no, so they've picked good winners, and now we want to transition into the model. Like we want to get diversified, and we want to sleep at night. And what that looks like is a relatively aggressive cover call strategy where we are capping our upside on these stocks that have already ran significantly, but then we're using the premium, after tax premium, as this after tax premium is going to help pay your tax bill. So we're trimming out of these positions over time. The proceeds are going to the desired model allocation, and in the meantime, we still are participating in some of the up moves of these stocks. So you're spot on. It's not just one stock. In fact, we often do, if there's a Nvidia and an Apple, which who doesn't have both? If you have one, concentrated positions, then we can collar both of those positions within the same account, effectively reducing that concentrated position. So.
Yeah, and if you haven't had exposure to either of those stocks, whether it's outright or the index, just call your advisor and just fire them. You
Yeah,
just
you're in
missed all
trouble.
the returns the last 15 years. You mentioned something about after tax, right? So let's maybe, I know, you should always consult your tax expert for all the compliance people out there that want to let this out there. There's some tax rules, right, with options, right, like a qualified call or straddles, right? That's something that you and your team manage along the way.
Yes, of course. That's something that we are happy to give our input on. Obviously, not tax advice, but the one thing that comes up quite a bit, and it would be a big error if you did make it, is the straddle rule that you mentioned. And essentially, the rule is that you have to have at least 15% between your put and your call strike. So if you're collaring your position, and wouldn't it be nice if we could just collar it at the money so we have no risk, right? And we'll just hold on to this until we get a step up in basis. Well, there's understandably so that's not allowed, and the industry accepted width is that 15%. So anything tighter than that would be not considered taking enough risk, and therefore you would have to pay taxes on the position as if you sold it that day. So that is the constructive sale rule. That's something that we're monitoring and making sure that we do not, go inside of that, because it would be in some cases it would be a huge issue for these clients.
Yeah, and I think that's a reason. Maybe we'll pivot here, but I'll make a comment on ISOs as well. If you're an executive and you've exercised ISOs, maybe you're in a position where you've exercised and retired, you got to be really careful about engaging these strategies. The IRS has specific rules. You always want to make sure you talk to a qualified, licensed CPA about hedging these positions, because you can restart capital gains clocks. It can get really messy. So, you got to be really careful, because, we've seen clients come to us with real, complexities and disasters, whether they're from like other hedging strategies, like a prepaid forward or like straddle violations. And I'll tell you right now, paying for your regular accountant does not know how to handle this. You need to go to unwind these things. You need to go to a specialist, which is going to charge you, 2 arms and a leg to figure all this stuff out. So really, really, really critical. And maybe we can talk about what Aptus is doing, is to have this professionally managed, right? There's so much complexity in this. There's institutional buying power. Let's talk about what Aptus does. Like, what are you and your team? You specialize in this, but what makes you different?
Yeah, on the overlay side, something we pride ourselves on is being willing to sell shorter duration calls and be more active in our management of the strategy. So the reason it's beneficial to sell shorter term calls is we want to give the stock as little time as possible to run through our upside cap. Right. So if we can collect that in 1 month, then that's better than in 3 months, or there's a less likelihood of it running significantly above our cap. And I always go back to a case that it just has a little bit of bad taste in my mouth, where an advisor came to us and said they had a collar strategy on NVIDIA that they had outsourced to a different options manager, and that manager implemented a 13-month collar in NVIDIA. It just so happened that 6 months through that 13-month period, NVIDIA was up already 70%. So it's one of those things where you're really handcuffed. There's not much we can do at that point. because you're capped out, and it would cost you, you have to pay for all that time value. So it would cost you an arm and a leg to get out of it. Um, but with that all being said, the shorter allows us to reset our cap more frequently. So instead of being capped at 30% for 13 months, we may do a 3 or 4 month collar and be capped at 20%. And then if it goes up the first 3 months to 20%, then we're 20% higher than that the next 3 months, and 20% higher than that the next 3 months. So, we have a good case study there that just shows the benefits of how much more upside participation you would have gotten if you were shorter in terms of how far out you looked, and active in nature.
Got it. And I believe there's institutional power in this, right? Like by going to Aptus, your team trades billions of dollars of options, right? So you have the scope and scale, right? Options, just like if you were going to go buy 10 cars from a car dealer, they're going to give you a price pick, right? Like if you're buying, you have buying power, you've got block trading, you've got that institutional power. That makes a big difference, right? Like if I'm just, going on my iPhone and going into Fidelity and buying some options, the pricing's going to be different.
Yeah, it makes a big difference, especially when we're talking about less liquid stocks, like where spreads are wide. We're able to use Bloomberg and even go to the desk and make sure that the pricing that we get is the best out there. So from a Bloomberg perspective, we can input implied volatility assumptions so that we're setting limits that are you know reflective of what we're currently seeing in the market, as opposed to saying, the spread is $3 wide, let's just throw in a limit at the mid, right? I mean, that's what you would probably see a lot of people do if that'd be maybe an educated investor's take on trying to trade between some of these wide spreads. But then to take that a step further, for our bigger positions with wider spreads, we're able to call the desk at Fidelity and Schwab and say, this is our order. Can you get us some bids, right? And then Jane Street and Goldman, they're gonna hit us with their best offer, and then we select the best one. So that's something that we use to differentiate us, especially on those wider spreads, less liquid names, especially really big positions too.
I think a key differentiator, as well, is if we look at like your peer group, I won't name any names of some of the big box stores, right? They offer this, but they do it in a more algorithmic fashion, right? It's a bot. We have all this AI stuff. I was joking with a friend this morning. It's like, wealth management stocks are down this week because there's some AI, coming out. And it's like, how does this stuff work in reality? A lot of these algorithmic trading and retail investors' accounts, the experience is bad because it's a bot doing it. And what can happen on the covered call side is, they've got predetermined rules. And all of a sudden you're like, wait, I thought this was a protective strategy. Why do I have a $300,000 debit in my account? Because they just keep on trading the calls and they use margin to continue to trade them. Where it's Jake and 10 and the team, human beings looking at accounts, right? So this is more boutique style.
Yeah, and the one thing that sticks out there is our communication, right? Like up front, we want to make sure that the advisor and client are educated. They have realistic expectations of what they can expect us to do, whether that's worst and best case scenarios within the strategy, or any day that we trade, as Sam knows, we bug him a lot. We'll send out an email at the end of the day saying this is the trade we made and this is why we did it. So that gives you another touch point, obviously, but it's just to stay informed. So that we're looking at the account and that we are executing on the investment policy statement.
Yeah, I think a lot of times when people or investors or clients get into covered call strategies, they see a proposal from a big box store and they say, whoa, I can get $300,000 of income. Well, that's assuming the stock price is below all the strikes, right? And then all of a sudden they're like, wait, I thought that was income, not a $300,000 margin balance. So with any of these strategies, I think it's absolutely critical. Just, we hammer this as a firm, but partnership education, you gotta be educated on these strategies because they all have pros and considerations, and they need to work for you in your specific situation. So that's why it's important to have a plan. One of my friends, always says, either have a plan or you're part of somebody else's plan. So I think for if you're listening to this and you're interested in this type of strategy, set up a meeting, talk to myself. We can get Jake involved. But these are strategies that can really work well as holistically with other strategies in a vacuum by themselves. It just depends on what you're trying to achieve. Jake, I think we did a little better on this take. I appreciate your time. As we end every podcast, what's going on with Jake? What's going on with Aptus? The floor is yours. You could say whatever you want to finish us out.
All right, let's do it. So I've got baby number 3 coming soon. So that's where we're just hunkering down, getting ready for that. New at Aptus, we're constantly coming up with new strategies. We actually have something. We might have to do another podcast soon because we've got something cool on the alternative lending front where we're replicating a margin loan for a better rate, tax advantage. So maybe we get on here again soon and talk about that in more detail.
The box spread.
Exactly. Yep.
All right. Well, we'll fire that up on another podcast. Jake Marriott, thanks for being with us. Wishing everybody a happy and healthy day.
Thanks for listening to the G360 Wealth Podcast. If today's episode gave you something to think about or act on, share it with someone who might need it. Don't forget to hit subscribe so you're always in the loop. If you want to learn more about how we help families like yours simplify and grow their wealth, visit us at generationcapitaladvisors.com. Until next time, take care and keep building. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Generation Capital Advisors. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Investment advice offered through Integrated Partners, doing business as Generation Capital Advisors, a registered investment advisor. The information in this material is for general information only and is not intended to provide specific advice or recommendation for any individual. Integrated Partners does not provide legal, tax, or mortgage advice or services. Please consult your legal or tax advisor regarding your specific situation. All investing involves risk, including loss of principal. No strategy assures success or protects against loss.